So now let's look at what comprises a credit score, okay? What we're doing here is we're painting a picture, okay? We want to paint a picture of a profitable client for the creditors, okay? Somebody who borrows money, always pays it on time, and doesn't take undue risks, okay? We want to look like we're paying all kinds of interest and we're really profitable, and they're making tons of money off of us, and we're really secure because we never miss a click, okay? They look at how much credit do you have available, okay? Specifically, revolving credit is very important on that, okay? That's the amount of credit that you have. They look at how long have you had it, which is history. How much, how long. We want to show them, gosh, we can borrow $100,000 at the drop of a hat, and I've never overextended, never missed a payment. That's who they're looking for, okay? They look for mix of credit, which is a variety of different credit types, which would be installment credit, which is closed-ended loans. That's something like a car that you get and you pay off, or an RV. Revolving credit and mortgage credit. Ideally, you have all three. Okay. Now, one of the big factors now is what they call utilization of debt. This is what John just mentioned a minute ago. How much of your revolving credit line or lines are you using? Percentages. These are really important, okay? Just because they give you a $10,000 card doesn't mean they want you to use $10,000 worth of credit, which is confusing, because why would they give you that much if they didn't want you to use it? In the credit scoring system, ideally you're under 30%, okay? Up to 40% is not a huge deal. It's not going to be a big impact. You step over 40% of your credit limit, either on an individual credit line or collectively on all of them, they're going to whack you with a big stick.
Wow.
But that's a big impact. It's 30% of your credit score. I've seen 50, 60 points overnight just by changing those balances. Right?
Wow.
So
It's how much, 30% of the, or 40?
under 30%.
No,
is
I knew
ideal.
those ratios, but
40% is the line where it gets pretty
but
drastic.
it comprises how much of your credit score, did you say, Derek?
30%.
Okay, wow.
30%. It's a big factor. It's the biggest single factor.
What about like, a lot of times, years ago, we used to call it a second mortgage. Somebody would go in and have a $100,000 home and owe $40,000 on it, and then they would go into a bank and borrow.
That generally is not calculated as revolving credit now, in most
Okay,
cases.
yeah, because I was worried, like, if somebody got a lot, you know, typically what they do now, like, will take out a line of credit for $30,000 against it, and obviously borrow the whole thing all at once on a line of credit, so that doesn't count in that.
Right.
Okay.
Right. And now we're going to go to the other end of that spectrum a little bit, and that's that stash of credit cards you have that you never use. Ideally, the ideal is a 1% balance. It will actually score higher than 0.
Oh,
Okay? So what I advise our clients to do is, for probably 3 months before you do a major purchase, tickle all those cards a little bit. Keep a little balance on them, running up to your limit. I have seen up to 50 points with that tactic.
jeez.
That's a pretty new one.
Could you repeat that again?
1% balance on your revolving credit lines
Okay,
it scores higher than 0.
okay.
So like
Take
if you
out
had
all
a
those cards you
10,000,
don't use and tickle them all for 3 months before you go do your mortgage.
so if you had a $10,000 Visa limit, then if you had, you know, $100 on it, that's what Derek is saying would be your ideal target.
So do the paperwork hassle, make the extra payments for a few months, and complicate your life. It's worth it, because if it gives you more points, you get a better mortgage. Everybody's happy. These are powerful tricks. People
What
don't
if you
know
pay
this.
it off every month?
That's what he's saying, is to leave $100 on it.
Oh, I see, let it revolve.
Just for a few months until you close the loan, then go pay them off and put them away. That's a good trick.
Wow.
So yeah, that utilization of debt is a big one. And the other big one, of course, is payment history. You want to make sure the payment history is good. Now, this being said, what they're looking for on these reports is not individual pieces of information. They're looking for patterns. Okay? If you have a late payment a year ago, and you've got 17 open credit lines, okay, that one late payment is probably not going to affect your score much. It's built into their model. People are human, they make mistakes. You're obviously doing almost everything right and it was an isolated incident. If they see a pattern, 5 or 6 different accounts that get a late payment all in the same period of time, you got a problem, okay? If they're new, you have a problem. All these things are time weighted. The farther they go into history, the less they affect the score. A new late payment is the kiss of death. Because what their model says is there may be something bad developing here. We don't know yet. So once that late payment becomes 4 months, 5 months, 6 months old, if it's a single late payment, not a big deal. But if you make a late payment this month, you're going to see a big dive in your score. It'll bounce right back up over the next few months if there's no more. But time waiting is really critical with that. So if you see that and it's just one isolated incident, maybe you say, well, let's just wait a couple months.
You mentioned a few months. How many months does it take for a credit score to go up or down?
That's a complicated answer. It depends on the lay of the report, how much it is. Like I say, if you've got 17 accounts and one of them went bad, it's not going to take that long because the bulk of the stuff is still good. If you've got one account and one of them had a late payment, it's going to take a lot longer because it takes longer for that pattern to change. So it depends on the whole background of the report. Does that make sense? Now, that being said, if these things get complicated, and they do, one of the things that we do is we offer a free initial consultation to all of our clients. Happy to do that. We do not do business with everybody we do a free initial consultation for. It's free. What we get is a lot of goodwill and a lot of referrals and some customers. So if you have a client that is having challenges with that, and they want somebody to go over that credit report and just explain to them what everything is and lay out a plan of here's what's got to happen to make this better, whether they're ready to do it at that moment or not is not important, but take advantage of it. Shoot them over to me. We don't do a high pressure sale, real informative session, and we'll explain all that stuff to them, and we can talk it over with you if you've got questions on what's going on with that stuff. More than happy to put our expertise to help for you.